Kombat is the gift that keeps giving. In February, we moved to underground mining, and that's really where we started to demonstrate profitability. For every ton that we put through that mill, we're producing more than 2 times the amount of copper. So we'll expand the mill from 1,000 tons per day to 2,000 tons per day, and we need to get deeper in the mine. Expanding the size of the operation has a material impact on that profitability. The next year, with the contribution of Assets Far West, the EBITDA and operating cash flow should be over 100 million.
All right, today we're having a discussion with Jed Richardson, the CEO of Trigon Metals, an operational copper producer from Namibia, a long mine life, infrastructure in place, ramping up to 70 million pounds of copper production per year by 2027. The whole shebang. Now, that company is only worth 40 million Canadian dollars on the stock market today, so that might just be a very interesting value proposition, and that's why we're here today to find out. So, Jed, it is amazing to have you on the show. Welcome. Perhaps we can start off with a short and sweet 30,000 feet overview of your business.
I think you got a good intro there, but main thing, this is the restart of a copper mine that was built by Gold Fields in the country of Namibia, so Southern Africa. Fantastic country, great infrastructure, so we ship our concentrate out on fine paved roads to the port of Walfish Bay. We inherited a lot of infrastructure because of that history, and that's really what makes us a unique investment proposition. Not only did it give us a head start as far as capital to get into production, but it gives us the capital infrastructure also for our growth. So where we're standing right now, we'll produce about 12.5 million pounds of copper this year at an average cash cost of just around $3 a pound of copper. Going into next year, we'll expand production, be at about 26 million pounds. Our operating costs will drop down to closer to $2 on a C1 cash cost. And then the real big piece of what makes this an interesting investment is our Assets Far West expansion. This is a shaft that was commissioned by Gold Fields. Over $90 million was spent sinking this shaft, and it has an opportunity to take our production from our 12.5 this year, 26 next year, up to over 65 plus almost 70 million pounds of copper by 2027. And the infrastructure is already in place for this. So I think that's the key pieces of the Trigon story. We're steadily producing more copper each quarter, where our operating costs are coming down each quarter, and then we're doing so with I think an unmatched growth profile ahead of us, that we can arguably bring into production ourselves. I think that's a key distinction from a lot of resource investment opportunities, is that where you either require a massive capex up front that means that the company needs to be sold in order to see that asset realized, or an enormous amount of dilution in order to bring the mine on. We've been able to do this mainly by inherited infrastructure, a successful sale of a silver stream, and we are where we are right now, with good production and a fantastic growth profile.
Excellent. So many threads to pull on there, but let's start first with the main juicy one. That's, of course, that ramp up into 2027. You already started hinting at that. Sure. The shaft is there, and that's already been invested by a party before you, so you can now reap the benefits of that. Is your plant fully up to speed? And what else, what other investments are required in that ramp-up story to actually get to that 70 million pounds of copper production?
We're now running the mill at over 1,000 tons per day. Recently, we stopped mining from our open pit. So we initially started mining open pit. In February, we moved to underground mining. And so far, we've had a blend of open pit and underground over the last few quarters. And that's really where we started to demonstrate profitability. Now, our open pit, the average grade is around 1% copper. From the underground, we are closer to, right now we're about 2.3% copper, but that'll grow up to 3.1% copper as we get deeper. So for our mill at 1,000 tons per day, using the underground ore just makes more sense. For every ton that we put through that mill, we're producing more than 2 times the amount of copper. That's increased our production monthly, and it's also reduced our operating costs. So we're increasing our profitability. Now, For the growth, though, we do need to both expand that mill. So we'll expand the mill from 1,000 tons per day to 2,000 tons per day, and we need to get deeper in the mine. So we do need to do an investment of about 10 million US to do so. We're now working with lenders for that. We currently don't have debt on our balance sheet, and we're looking at using debt to get us to that next stage. And that should get us to a point where, if copper prices stay in and around where we're at, or just around $4 a pound, we should have EBITDA in the area of 40 million US, based on that 26 million pounds of production. So that in itself will put us in a pretty fantastic position to continue our growth. But also just for those following along as investors, 40 million Canadian market cap with 40 million of EBITDA in the next year, I think that's a pretty good value proposition for everyone.
It is definitely interesting, and that's why we found your story in the first place. Currently, I don't own shares in your company just yet, but I am very compelled to continue my research story. So perhaps we can get started with going into the details of that. So you're talking about potential lending opportunities, getting a loan to finance that. Let's say in a worst case scenario that's actually not possible. Would it also be possible to finance this through cash flows if you just spread it out a bit further?
You mean to push back the dates? That there's some potential there. But like I said, I'm feeling pretty confident about the path that we've got. But yes, we are generating some cash flow. Kind of at this stage, we're just starting to build some cash flow. Expanding the size of the operation, it has a material impact on that profitability. Like you can see, like the margins right now, it's just we should going into our Q3. So that's October to December quarter. Now that we're just underground, we should probably be around $2.70 C1 cash costs. To get an ASIC, you could add about 45 cents to that number. Pretty good profitability, but you can see the impact of just having more tons of copper or more pounds of copper to defray that operating costs, and doing that expansion. That takes that profitability. Not only does it lower just divide the fixed costs over more pounds, you get profitability going from, maybe we'll bank in the area of $6 million this year to over 40 next. Sitting at this level is not the best use of time and resources. It really is about going after that growth.
Yeah, makes complete sense. All right. And that jump from 6 million profitability to 40 million, of course, sounds very compelling. Perhaps we can talk about what kind of inputs a potential investor watching this video should use for their modeling. You already started outlining the profitability we should expect, but perhaps you can outline what kind of poundage you're actually going to be producing, and what kind of cash cost over that ramp-up period we should be expecting.
So in all of the forecasts that we're doing, we're looking at $4 copper. In that, like I said, you'll see in the last 2 quarters, our C1 costs were $335 in our Q4, and then $323 in our Q1. We're just finishing Q2. We haven't put out any forecasts there, and I don't want to get into too much trouble, but I think looking at it being similar to the quarter before, I think we can we're not stepping out of line to say anything there. Where things get more interesting is now that we've stopped open pit mining and we're exclusively underground, both the pounds of copper will increase and the operating costs will decrease. It just if you were to add up the quarters, you can see to hit our numbers, we're going to have some big production in Q3 and Q4, and that's what we're expecting. We did 2.2 million pounds in Q1, and like I said, should be something similar in the quarter that's just completed. And then going into Q3 and Q4, then 3.5, 4 million pounds should be where we're what we're coming in at, and we'll see operating costs come down below 3. It's early days in the quarter, but getting just so you can see the average that we're expecting. I think we have an average cash cost of 315. Just trying to make sure I'm not speaking out of line. So what's in the public domain? I think we have an average cost of 315. So in order to keep that to in line with that average, we definitely need to be below 3 in the next 2 quarters, and I think we'll be comfortably below that.
Excellent. I think that was a great overview, Jed. Now, what I would love to transition into is actually your ore body at the Kombat mine. You recently released a news report, I believe on the 8th of October, with 11% copper and 120 grams of silver, roughly speaking, over 5 meters. Those are some amazing results. Yep. Perhaps we can talk about what kind of life of mine you currently have in your resource and what that low-hanging fruit is for exploration.
Right now we have a resource. It's 13.5 million tons. It's at 2% copper. That gives us more than a 12-year mine life at our even at our expanded production. But what is really notable about the results that you're referencing is this is an area that was within our existing mine envelope. So we didn't branch out into a new area. What we did is test an area where we hadn't determined that there was mineralization before, and you come back with what will ultimately turn into the kind of stope that can help you make quarters, right? That's very high grade material. I think in the press release we also made reference to the minerals in there, that we're generally chalcopyrite and bornite, which are great copper sulfide minerals. There's covalite in this body, which is just simple CUS, very simple mineralogy. It floats very well. We are already enjoying 93% recovery with covalite. That'll only help us. So this is a nice little gift to have that's within our existing resource envelope. Some of the history of this mine is that in the stopes, there's generally over 100% recovery or conversion of reserve to ore. So what that is that the miners go into a stope, they've got an idea of the grade and the size, and they end up finding more than was originally in the resource. In fact, there's at the early part of the underground mining, we were getting up to 200%, and I'll say we actually had to tone that down, because what was happening is the miners were taking not only the really good stuff, they were also taking some of the lower grade stuff around the high grade bodies. But we've got now a lot of experience in the team, a lot of a skill in planning, and we're still getting that positive recovery, and we're getting the benefit of these new bodies that we're finding in and around the existing infrastructure. Sorry to be a long-winded answer, but our VP exploration, Andy Rumpel, and the mine resource geologist Sydney Gara at site, they've been working on what they're finding mineralogically. There's some new consistencies that we can see showing almost like a rhythm or a pulse to the mineralization that was really valuable in those drill holes that we talked about earlier in the question. And using that, we have some other targets that we'll that we'll be following up on, again, close to existing infrastructure. So we I think the comment I put in the last news release, if I were to paraphrase it in colloquial terms, it's like the Kombat is the gift that keeps giving. Like there's still so much more here. We have a 45-year history and a resource that's bigger than what was mined out over 45 years. There's still a lot more to discover in and around this deposit.
Okay, that's very interesting, Jed. Thank you for all that detail on the exploration potential near mine site. Now, I would love to transition to your newly acquired exploration properties that you have been acquiring. Perhaps you can tell us what is the rationale behind this if you have so much low-hanging fruit exploration potential near mine site.
So it's really twofold. One, we really love Namibia. There's a lot more in this country. So we're always going to be looking for opportunities to grow. The other is we are in April. The shareholders, and we're anticipating this. They voted to spin out our assets in Morocco, and we're still working on that. We've got some great exploration assets there, and we'll be launching them as a new company that'll be dividended 100% to our existing shareholders, and it'll go under the name Safi Silver. So in a lot of ways, those exploration projects were to replace Safi. And that goes back to early in my career as a research analyst. A really, I think, proven formula for how to build a good mining company is to have a strong asset that you're cash flowing from while developing your lottery ticket asset that can be the big upside winner. Those Kalahari claims, those are properties that we were buy from the relationships that we've built in Namibia. We were able to get a hold of. This is 960 square kilometers of ground on a belt that has already produced $2 billion project areas. That's the type of lottery ticket that you want. It's in a jurisdiction that we already love and we know. We have a lot of goodwill in because we've restarted in the Kombat mine, employing now within ourselves and multiple shifts and contractors, over 300 employees. So with all of that goodwill, we're now developing in an area that has a potential to produce the type of project that either gives us a huge opportunity to grow or makes us a target for a BHP or a Rio Tinto. Notably, our neighbor is Rio Tinto on the Kalahari Belt.
Yeah, that's always great to hear. And you already touched on Namibia a couple of times. Could you perhaps explain why you really love Namibia as a mining jurisdiction?
Okay, sure. One, it works. I've spent through my career, worked in Brazil, I worked in Mali, which was not a whole lot of fun. And then you come to a country like Namibia. Namibia, unlike the rest of Africa, mining is the top industrial industry, not agriculture. I was there with my family for months, but I'm in Namibia regularly. I drive around in a truck with our logo on the side, and I get nothing but positive feedback. Like at gas stations, I get CVs, and everybody wants to talk about what they know about Kombat, what they heard, and I can remember when we were going through permitting. They knew Trigon Mining because they heard we were working to bring the asset back to life. That is not the situation in many parts of the world. I spent a lot of time in Latin America, and that I would not drive around with my company logo in Chile or Peru. It's not going to earn me a lot of friends. So I think Namibia is unique that way. And then beyond that, as far as working in Africa, and I think a lot of people have preconceived notions of what Africa is, and I just like to remind people Africa is not one country. It is, I think last count is 54. There might be a few more, but Namibia really stands out as a great place to work. I'd say maybe Botswana and Morocco would compare. But it's a short list of places like that. You've got great infrastructure, the power I can rely on. I've got clear processes and pathways with the government to get assets permitted. Even when there's disputes, they get resolved, right? Like Namibia is unique in Africa, but it's also, I think, a unique and positive jurisdiction globally.
Excellent. Thank you, Jed, for explaining why you are in love with Namibia as a mining jurisdiction.
Yep, sure. I can go further.
I think for a quick overview, we're okay with this. Perhaps we can transition to the financials, a bit more dry. Apologies for that.
Sure.
I would love to talk actually about your streaming arrangement you have with Sprott. It's currently being carried on the balance sheet as a $25 million liability. Perhaps you can explain actually the mechanic behind that and how investors should view that obligation.
Sure. So we hit a key milestone. Even when we were working on that agreement, it was foundational to how we capitalized the company and getting the operation into production. We knew there was a lot of upside at the mine. When we were shopping for a streaming partner, we looked for two things. One, a group that would give us value for the potential we had, and two was an ability to buy back part of this stream. In that agreement, we described it as a carrot and a stick. The stick being that if we didn't meet minimum levels of production from underground, that the stream would convert fully into a debt. And that gave some protection to our streaming partner, and then gave us some pretty stern motivation on making sure we hit our production milestones. And we did so 13 months early. I point to Rennie Morkel, our President and Chief Operating Officer. He really saw how important the underground was. We moved up our plans to produce from underground. We had been planning to start underground production in April. We ended up starting in February. And then we've done so well that now we're at a stage where we've stepped away from the original plan, which was to be half open pit, half underground, moved to full underground, and that's allowed us to hit our stick milestone, right? And that now means the stream stays 100% a stream. It does not convert back into debt. It does sit on our balance sheet as a debt, and that is really more to the mechanics of how a stream differs from a royalty, that it sits with the company as opposed to with the license, and as a result it needs to sit as a debt in order to always have a validity and exist with the company. So it sits as a debt, but that is not. It will be worked down over the life of the stream. It is not a debt that has, accelerated payments or increased obligations. One thing it does do is it does tie up the security. So there's security for the stream on the asset. So it sits on the balance sheet as you see it, but it is not something that's going to impact us more than the regular stream payments. The other part of the stream, though, is the carrot. Currently, that stream, because they gave us value not just for the 13 million tons that we have at Kombat, they also gave us value for what we expect to find at Asses Far West. In the current time period, they're receiving some of our copper as well. So it's 90% of our silver and 6.5% of our copper. So it's pretty onerous terms right now. Once we bring on Asses Far West, it drops to 1.625% of the copper. So the copper portion falls away dramatically. And that's the motivation we have to now bring in that next stage of growth at we will ultimately change the profitability. And if you look at our cash, our projections, it shows our operating costs dropping to around $2 a pound in our next operating year, and then it falls even further once we bring on Access Far West. That's the main contribution of that is actually the reduce of the cost of the stream. I think that's the best way to look at it for investors, as both it allowed us to get the capital and to be up and running really before our peers, because it gave us capital at a time when the markets weren't ready to fund projects like this. So now we're enjoying $4.30 copper, while I'd say most of our peers are looking for that $4.30 to help them raise the money to get their assets going.
Excellent. I think it was a great overview, Jed. Really thank you for taking so long, also explaining those incentives behind that streaming obligation. Perhaps we can end off this overview actually with your expectations for free cash flows. We have talked about EBITDA already, but free cash flow for 2025.
Yep.
I think that's a great figure to share with potential investors, and then we'll end it off.
So I will note, the EBITDA should. I'm using EBITDA numbers because it's easier and clearer for me to see and project, but it should approximate operating cash flow. Now, there are still stages of our growth that we've got planned. So if we were looking, like I said, this year, we reported a small operating cash flow. I think it was just under adjusted. It's just under $1 million for our first quarter. And we should do a bit better than that in Q2. And then I said, for the year, maybe it's 6. Next year, then with that expansion, we should be up to 40. But we also still have our investment at Access Far West, so I wouldn't look at that as free cash flow yet. There's going to be both debt repayment and drill work in and around Access Far West to complete. Full investment at Access Far West will be $35 million plus equipment. We'll have to expand our mining fleet, and we'll do that likely through lease agreements with Epiroc, which is what we've done for our main mining fleet. Then getting into the next year with the contribution of Access Far West, then the EBITDA and operating cash flow should be over $100 million. Stepwise getting there, but hopefully investors will have the patience to ride along with us. But like I said, a pretty enviable growth profile that's doable from within our own means.
Definitely. Very interesting growth profile, 100 million in operating cash flow at some point. Very exciting. Jed, thank you so much for your time. Really appreciate it.